At least as of now. We have Shibani Sircar Kurian joining in to take this conversation forward. Of course, she's from Kotak Mahindra AMC. Shibani, always a pleasure having you on the shows. Good to see you. So tell us, what do you think? So much has happened, right? Exit polls, then the election swing, the shocker, the absolute soaring temperatures, then the realization that maybe it's a coalition government that will last. So it's been a total roller coaster. But now, what's the stance that you're taking on an area that you've traditionally always liked for years, which is Capex, which is manufacturing?
So hi, Surabhi. Absolutely, it's been a roller coaster, but now it's back to basics and back to fundamentals for the market. Now, before the elections and even post the election results, there was a lot of debate about continuity of policy and focus on investments. Our belief is that now that seems to have been put to a rest. Of course, we'll get to know more once the 100-day agenda is announced and we go into the union budget. But our belief is that policy continuity is here. And therefore, what has been happening over the last few years is investment-led growth, which is likely to continue with focus in terms of maintaining the path of fiscal consolidation. The good part is that the government today does have extra resources at their disposal, specifically in form of the higher RBI dividend that we have received. And that should also help them channelize some of incremental resources towards boosting consumption at the bottom of the pyramid. But specifically on the Capex side, I think the Capex focus continues, specifically on the public Capex, which has been driver of the entire investment revival that we have seen so far. Incrementally, our belief, and it has been there before as well, that there are signs of pickup on the private Capex side, though very nascent signs. Corporate balance sheets being strong means that with capacity utilization in the overall system being at almost all-time high levels, you should start seeing the private Capex pick up. The next cycle of growth where infrastructure and investment is concerned will have to be driven by private Capex, and that is something that we will wait and watch for. In our portfolios, our overweight stance that we've seen on the entire manufacturing and infrastructure side remains. However, we are also cognizant of valuations, and therefore where valuations are extremely rich, those are pockets that we would avoid. But the portfolio stance in terms of the sector remains unchanged.
Okay, hi Shibani, good afternoon and good to see you in. Talking about areas where valuations are rich and some of them have very, very good policies in their favor. Defense in particular. How do you approach these stocks? And some of them are up more than 10, 15 times in the last couple of years. And they are factoring in, I think, next 3-4 years earnings. But that's not stopping these stocks. They keep moving up. How are you all positioned on this sort of a theme? Because there's tremendous potential. But at current reckoning, maybe some part of the good news or most of the good news is in the price.
No, absolutely, Nigel. But this has been a theme that we have been positive on for a while. What we have seen in terms of the policy focus, the indigenization of defense manufacturing, and more importantly now possibly the export opportunity that remains very, very large. It is possible that given the kind of run-up that we have seen and the valuations at which some of these stocks are trading, you might see a pause. However, the theme remains intact. And therefore, when we are looking at the sector, we have to take a slightly longer term view in terms of how the sector dynamics are likely to play out. And from that perspective, there are still segments within the space where we would continue to have exposure on the defense theme in our portfolio. Like I said, where there is a mismatch in terms of fundamentals and valuations have become extremely rich, those are pockets that we will avoid. But as a theme, defense continues to be a theme where we remain fairly positive on.
Okay, defense continues to be a theme, but look at that move in 12 months. Paras defense up 140%. I mean, a large chunk of that has come just in the last, 1 month or so, and 20% higher in trade today. So big moves coming in there. You said manufacturing is also a space that you like. Shibani, investment-led growth is something that you like. What about IT? I know it's been an underdog for a while, but do you think that fortunes could change?
So absolutely, Sonia. If you look at, with a lot of debate on valuations, if you look at valuations or in sectors where valuations are still reasonable and attractive, 3 sectors come to mind, and IT is one of them, specifically the large cap IT players. While the mid caps have still continued to outperform, large caps are still trading at valuations which are fairly reasonable and attractive. If you look at IT, there are 2 key parts to it. Structurally, we believe that the demand for technology is here to stay, and as new technology evolves, specifically with respect to AI and Gen AI, the need for IT services and the growth opportunity remains intact. The problem clearly has been near-term, specifically with respect to discretionary demand for IT services. And given the fact that macro uncertainty at the global level, specifically in the US and the European geographies, continues to remain high, we've seen that IT spends have been muted. Now, this possibly could continue maybe for the next 1 or 2 quarters. I think in the near term, the trigger for the sector could be any decision that is taken by the US Fed in terms of a rate cut, which can be a near-term trigger. Structurally, however, we believe that maybe over the next couple of years, the growth in terms of the requirement for IT services will come back. And in that context, if you look at risk reward, especially where some of the larger players are placed in terms of valuations, the risk reward is in your favor. However, you may have to be a little patient for the next few quarters to see some of the improvement come through. The other factor is IT typically does see seasonality. So first half is strong and second half is weaker. But if in this sort of a context where first half can still see muted outcomes on growth, one may have to be a little patient to see some of the growth come back, which will be the key trigger for multiples to re-rate.
Okay, got it. By the way, the mid-cap index is springing to life. There's a gain of about 0.4%. I just want to call out 1 or 2 stocks that are looking very active. And there are big price moves happening. Pull up Pricol. Pricol is up 10 to 11%. Just some interesting stocks that are still bouncing around. Pricol is one. Ramakrishna Forgings, so that's days high on Pricol. Ramakrishna Forgings has seen a lot of buying in the last half hour as well. That stock's up about 9%. And then there are some monsoon-related plays, something like FACT, Fertilizers and Chemicals Travancore, if you want to know the whole name again. 13% up. So that's Ramakrishna Forgings days high, and FACT is seeing some very interesting buying. So even on a day where originally mid-caps were not doing too well, there's plenty of flair in the market that seems to be showing up right now. Shibani, I know we can't discuss individual mid-caps with you, but really, what is the approach to this basket? Because the rally is well and truly back. Last week, it was all about mid-caps and small caps all over again. Those indices have gone back to their record highs as well. So as a house, what's the call? I mean, what sort of themes, at least, mid-cap themes, are you still comfortable owning and buying afresh, of course?
So as a house, what we have believed is if you look at the entire market construct and valuations have been again off debated. What we believe is if you look at the large caps, specifically if you look at Nifty valuations are just marginally higher than what their long-term averages suggest on a one-year price-to-earnings basis. And therefore, from a market perspective, risk-reward continues to be slightly favorable for large caps and some of the larger mid-caps. Now, the issue has been in terms of how valuations have panned out for the small caps and maybe for the micro caps. And clearly, this segment has outperformed. However, when you look at the earnings expectation that is built into this segment, this earnings expectation continues to remain significantly high. A lot of the re-rating that you have seen so far has been multiple led in pockets. And in those pockets, the earnings expectations are high. So therefore, from a risk-reward perspective as a house, we continue to believe that large caps and some of the larger mid-caps are better placed, given the kind of valuation, comfort, and growth outlook that you are seeing. Within the mid and small cap segment, what we will avoid as such are those pockets where stocks have moved significantly ahead of fundamentals, stocks which have moved up because of low float, and therefore there is again a significant discount or a disconnect, I beg your pardon, between valuations and fundamentals. And within the space, segments such as, say, for instance, if there are reasonable valuations on the industrials, manufacturing, BFSI, consumers, these are segments, or even auto and auto ancillary within the mid and small cap segments, we continue to be positive. The overall dominant theme that we have been playing across our portfolio has been domestic cyclicals and companies which are getting a lot of the growth from the domestic space. And that theme continues to play out both across large caps as well as mid caps.
Okay, got it. That's the advice on mid caps. Shibani, good talking to you today. Thank you very much for your time. Thanks for joining in. By the way, guys, Sonia, before I